Hey everybody, this week on the Business Owners Corner, I'd like to talk about charitable giving, particularly because we're coming up toward the end of the year. This might be top of mind for a lot of you out there. So I'd like to go over a real life example of the benefit of giving appreciated assets directly to charity or perhaps directly to a donor advised fund. A donor advised fund is basically your own foundation, but you don't have to go through all the legal paperwork and headache and maintenance and operations and all the stuff that comes with a full tried and true bona fide foundation. You can simply open up an account at your favorite brokerage firm and claim all the same tax benefits. So today we're going to go through a real live example of what that actually looks like and what the differences are. So here's our hypothetical example. Let's say that you're an individual filer, you have $200,000 in taxable income, and you have some stocks in a taxable brokerage account that have gone up in value over the years. Well, at $200,000 of income, that puts you in the 32% federal tax bracket. Let's say that you live in the state of California like I do, and you pay 10% towards your state taxes as well. Now, if your intent this year is to give $20,000 to charity, which is a very substantial gift, this has substantial tax ramifications. In this tax bracket at 32%, if you sold your holdings in your taxable investment account, you would be paying 15% long-term capital gains taxes on those gains, assuming that you've held these positions for longer than 1 year. If you've held the positions for less than 1 year, then your ordinary income rate applies, which would be 32%. So let's go through this example. You have a few stocks. I just chose these at random. Let's say that you have these values in the account. The total account value is $290,000. You purchased them initially for $130,000 collectively. So if you were to sell all of these stocks, you would have a $160,000 gain on your hands, which means that 55% of the $290,000 you're selling would be considered a taxable capital gain. So if you're in the position of wanting to give to charity here, you have a couple of options at your disposal. Your first option is to sell the shares, take the cash, pay tax on the gains, and then give whatever cash is left over to your charity of choice. It could be your church, it could be the United Way, the American Red Cross. Any bona fide 501c3 is a deductible, itemized deduction. So let's say that you pick out $20,000 of shares that you want to sell. Realistically, if you were doing this, you would probably pick the shares with the lowest unrealized gains as a percentage of the value. In this case, this would be Apple. So if you sold $20,000 worth, you'd have 40% of that $20,000 or $5,000 of gains to deal with. Let's assume that you sell these pro rata, meaning that 55% of the 20 grand that you raise is considered a capital gain. Well, because you've held the positions for longer than 1 year, 15% of that is due to the feds, $1,655. $1,100 is due to your state. Some states do recognize long-term capital gains treatment. California is not one of them, meaning that of the $20,000 of shares that you sell, that's going to incur a tax liability of $2,759. After paying the taxes, you've got $17,241 left to give to charity. That as an itemized deduction on your tax return. Remember, you're in the 32% federal bracket. 32% of $17,241 means that by giving that cash left over to charity, you save $5,517 on your federal taxes. In the 10% state bracket, that means that you save $1,724 on your state taxes for a total benefit of $7,241. So in order to liquidate the shares and give cash to charity, you pay tax on the gain, you get a deduction for whatever is left, and in this case, it saves you $7,200. If you could also sell more than 20,000, and I did these numbers beforehand so I know what it is, you could sell more than $23,000 so that after taxes you're left with a charitable gift of $20,000. Now let's keep it at $20,000 for now. Alternatively, you could give the shares directly to your charity of choice or to your own donor advised fund without triggering capital gains taxation, without selling them first. And most large charities are set up to be able to receive shares. If they're not, then you can set up your own donor advised fund to receive them. When you do that, you give shares to the relevant 501c3. You pick and choose what you want to gift. In this case, if you're gifting shares, you probably want to give those with the lowest basis, and you get a deduction for the value of the shares on the date of the gift. No liquidation needed. So you don't incur any taxable realized gains. You don't pay tax on that because there are none to pay tax on. Your net gift is $20,000. 32% of that, which is the tax benefit you'd receive at the federal level, is $6,400. You save 10% at the state level, meaning that the tax benefit to you is $8,400, or about $1,200 more than if you had sold the shares, paid tax on the gains, and then gifted the cash. Now, this works for any kind of appreciated asset. Stocks work great. You can also gift crypto. You can gift old cars. You can gift other kinds of equipment. There's all sorts of things that charities will accept, and they're oftentimes very willing and ready and able to accept them from you. If they can't accept whatever it is that you want to give, you might consider starting your own donor advised fund. As I mentioned earlier, donor advised fund is kind of like your own foundation. If you wanted to start a foundation, you have to go to attorneys to design the agreement. You have to get 501c3 status and jump through all these hoops and have operating procedures and file tax returns as a tax exempt entity. There are all these things that you have to do. It's a huge headache and really expensive in terms of ongoing legal costs. Instead, you can open your own donor advised fund, call it the John Smith Charitable Fund, at your local brokerage. Vanguard, Fidelity, Charles Schwab all have the capability to open this for you for a pretty low cost. You gift the shares directly to this new account. It is an irrevocable gift. You cannot get it back, but you get a $20,000 deduction, or a deduction for the value of whatever it is that you're gifting on the date that you gift it. The money goes into the account. The assets are sold. Cash that remains in the account after the sales can be reinvested, or it can be distributed to your charity of choice thereafter. So if you're someone who wants to give $5,000 a year to your favorite charity over the next 4 years, and you want to make it all in 1 year for tax reasons, which may be a good idea, you make one $20,000 donation. You put the contents in a donor advised fund, and then you instruct the custodian of your donor advised fund to send a check to your charity of choice whenever you're ready for them to receive it. And that is not a taxable event thereafter. The only taxable event is your initial gift to the account in the first place, or any subsequent gifts that you want to add to the account. The crux with this that you should be aware of is that once assets go into the account, whether it be cash or stocks or old cars or whatever, they do not come back. You cannot get them back. It is an irrevocable gift to charity, but comes with substantial tax benefits like we're seeing here.